Welcome back. Tactical Futures session number 17. Today we're going to talk about how do we pay for these futures contracts. And the way we pay for these futures contracts, it's called margin. And margin is an important part. It's going to be important to understand margin. Now, before we even dive into any of the details here, I want to stress this. Margin is something that will change based upon the value of the underlying, and margin can change without notice from the exchange and from your broker, both intraday margin, initial margin, maintenance margin. We'll talk about what all those mean, but they can change without notice. So it's important for you to understand, A, what are my broker's margin requirements, and B, what are the exchange margin requirements for the asset that I'm trading. So I would recommend just bookmark the website of your broker where margins are explained, and bookmark the website of the exchange so that you can very easily and quickly identify and see where that is. Now, we put this a little later in the session because we want you to understand the concepts of everything that you're doing. But the reason we put this down at session number 17 is because we want you to understand the concepts of what you're doing, what you might be trading, to then truly understand how margin works. Now, margin in the futures market is different than margin in the equities market. See, margin in the equities market is essentially borrowed money. It's money that you pay for. You pay margin. You pay a margin interest rate when you borrow money in the equities markets. If you're short stock or if you're using margin, that's not the case in futures. In futures, you actually pay nothing to access this capital. So, for example, in the S&P, it's $50 per point of the S&P. Well, that means that I can be controlling hundreds of thousands of dollars worth of S&P for a fraction of that cost, but I don't pay any interest on that. And so this is not margin in that way that I pay interest on it. So margin is a leverage tool allowing an investor to control an asset for a smaller amount of capital. That's what margin is. By using margin, an investor amplifies both the gain and the loss in each position. For this reason, margin should be used carefully. Margin cuts both ways. That's one of the things that you'll hear me say over and over again. Margin cuts both ways. So, when we think about margins, we got to always think about contract value, right? The contract value is the size of the contract multiplied by the last price displayed on the screen. For the indexes, it's the multiplier times the index value, right? Or whether it's in oil, it's 1,000 barrels times the current price of oil. That's the contract value. Margin is the amount of collateral or equity deposited by a client with his or her broker or clearinghouse. Okay, now remember this. When you make a futures trade, you're required to fulfill the contract value. The margin is just the money that you put up as a good faith deposit that you will fulfill that contract. If you, as the client, does not fulfill the contract, your broker has the obligation to fulfill that contract for you. And so, for this reason, the broker or clearinghouse is going to be the one that determines the amount of margin. Now, leverage is the use of small margin to control a much larger investment. The greater the leverage, the greater the possible gain or potential loss. And the risk is the amount of capital that a trader is willing to lose in order to make that larger amount of capital. So if you think about those kind of terminologies, we have control over how much we're willing to lose, but we don't have control over the full amount of risk because it can gap around us. So 3 key terms we need to look at are initial margin, maintenance margin, and day trade margin. So let's start with initial margin. The initial margin is the total amount of margin per contract that's required to open a position. This is typically going to be set by the exchange on how much capital are you going to need. And this is important because each broker may set separate initial margins, either higher than the amount required by the exchange, or sometimes lower. But the actual brokerage firm has to make sure that initial margin is really met. The maintenance margin is the minimum amount of margin per contract that must be always maintained for open positions. Meaning, if you enter into the position and the position starts losing money, it's theoretically possible that you could drop below your maintenance margin. And in that case, you would get a margin call. And the margin call means that you have to put enough money in your account in order to fulfill that maintenance margin amount. So this will oftentimes happen in an overnight scenario when there's some sort of a large market movement. If that maintenance margin you go below a certain amount on the maintenance margin, you've got to have a margin call in order to fulfill that. Now, oftentimes what's going to happen is they may just allow that position to essentially expire, or they'll close it out for you as a broker. And the last one on here to talk about is day trade margin. Now, this is the minimum amount of margin per contract that must be used to open a position, typically during the U.S. cash session. Day trade margins are oftentimes going to be set by the individual broker, and brokers will have varying margins that they may use in those positions. So, let's start with the CME website. So, for this example, we're going to look at the euro. And when we look at the euro, just for everybody's reference, every screenshot that you'll see here was taken on the same day within 10 minutes of each other. So you'll see varying numbers, different numbers here that shift, but it's important for you to understand why they may shift, and really what's the difference. So for example, the Euro FX. The euro has this is from the CME website. The maintenance margin on the euro on the CME website is $2,200. That's the maintenance margin for that euro. So that's the amount of money that must be maintained. Now, they want to make sure that that's maintained at the brokerage level. The broker is going to want to maintain that margin amount. So if I go look at this particular broker, this is TD Ameritrade, and this is the Thinkorswim platform, we can see that the euro, they have an initial margin of $2,420. So there's a maintenance margin of $2,200, and this particular broker has an initial margin of $2,420, meaning that this broker is going to make sure that you've got about $220 of loss per contract before you hit that maintenance margin, right? The difference between the initial margin and the maintenance margin would be really where the difference becomes. So if you drop below that maintenance margin, you could theoretically get a margin call on this position in order to fulfill you back up to that maintenance amount. Well, what about a brokerage like Infinity Futures? Well, if I look at Infinity Futures, they've got a $500 of day trading margin. Now, how do they do that? Well, because what Infinity Futures is essentially saying is we recognize that we've got enough capital to back up the mistakes of the client, and they're going to close you out of a position before you would eat into that maintenance margin. And so essentially what they're doing is they're only showing the day trade margin, which is a $500 intraday margin. Now, this is a very popular way for people to trade futures, is to use a very low margin broker. Now, the difference though becomes, think about the euro moves at $50 or $12.50 per tick. So a 4-tick move is going to cost you $50. It's going to cost you 10% of your investment, right? Or if it goes up by 4 ticks, you make 10% on your investment. Whereas on a higher margin, that's not going to be the same percentage when it moves 4 ticks. And that's always worth considering. Here's another example. This is the Interactive Brokers. And the Interactive Brokers has an overnight maintenance margin of $45.62.62 and the overnight initial of $57.03. So once again, you see that there are different numbers. Their day trade margin is also $57.03. So most brokers, they're going to have the initial margin over the maintenance margin. However, your value on the position must stay above that overnight maintenance margin in order to maintain that position. Now, you notice that there's no intraday maintenance margin in place because the exchange is okay with no concerns over the maintenance margin, but they do have the overnight maintenance margin, which is why many brokers will give you this call it a day trade margin rate that is really favorable for individual investors. Whichever brokerage firm you decide to go with, the value per tick doesn't change. The value per point doesn't change. The amount of capital that you put up will change. And so, it's the same asset that you're trading, just with different margin amounts on each one. But if your equity drops below the maintenance level, the broker must issue a margin call in order to restore the equity back to that initial margin level. And so this is where a lot of traders and investors get hung up, is that they don't understand the difference between initial margin and maintenance margin, and the fact that when it's intraday trading is over, it switches over to the maintenance margin amount. Now, with margin specifically, if you have questions, while you're always going to be able to reach out to us, support at TradersArmy.com, we're going to do our best to answer all your questions. I would also recommend calling your broker. Speak with your individual broker to explain how margins work for you. And remember, we don't take margins unless we understand the risk associated with them. So we'll be back in the next section when we talk about some of the protections in place with futures regarding limits and circuit breakers. So I will see you back in just a few.